The Wall Street Journal is reporting tonight that SoftBank is seeking to take control of WeWork through a financing package. And this is a perfect example of why you should not buy into the hype that you see advertised on the financial channels, and also why you should not buy into companies and IPOs that are losing money. They are trying to sell the dream that eventually they'll make money, and it's a sexy business like Uber or WeWork, which is co-working spaces. But a lot of people buy the stock or the business just based on the story and not on the actual numbers or the earnings. So a little backstory on WeWork. SoftBank is about a 1/3 owner in WeWork, and as recently as just January of this year, they invested $2 billion into WeWork at a $47 billion valuation. Okay, and they were expecting that they were going to have their IPO and that the valuation was going to be above that $47 billion valuation. But cracks and chips started showing in WeWork, particularly with Adam Neumann, the founder. He had a lot of shady kind of side dealings with some of these buildings that WeWork owned and things like that. And so there was a lot of questions going around. And not only that, but the IPO market was not looking that hot because of the way Uber and Lyft started losing, their stock price started tanking immediately after their IPOs, and they are also money losing companies. So a lot of people started having doubts, and because of that, SoftBank urged WeWork to cancel their IPO, because SoftBank was worried that if they had to IPO at a lower number, say a $20 billion valuation, then SoftBank would have to write down their investment at the prices that they bought it at, $47 billion, and some other investments at different levels, I think around the $20 billion level as well. So in their plan to IPO, they were hoping to IPO and raise about $3 billion, and with that they would have also gotten about $6 billion in debt, a debt deal done. Because that didn't happen, now they're scrambling for cash, which some people say they could run out of cash this year. And so it's looking like SoftBank is going to invest at least $3 billion, but the valuation could be something like under $10 billion. So basically 1/5 of the valuation that they bought in for just in January. So $3 billion at a $10 billion valuation, meaning they're buying almost 30% of the company for $3 billion, whereas before they were buying such a smaller piece for their $2 billion. So how did this happen, and who could have seen it coming? Well, SoftBank is not stupid, and they have access to these early private investments in companies that are potential huge unicorns, so to speak. And so they're playing the game where they get in early, they start at a lower valuation, a few years later they buy at a higher valuation, just so that the news can come out and say, hey, this company was worth $2 billion 2 years ago, now it's worth $20 billion, and it's gonna IPO for $40 billion or something ridiculous like that. If you look at their S1 filing for the IPO, you see this table here, and it says consolidated results of operations as a percentage of revenue. So this kind of explains it all. So if you say that the revenue is 100% in 2016, 17, and 18, their net loss on that revenue is 99%, 105%, and 106%. So basically what it's saying is that for every dollar they make in revenue, they lose $1. Okay? I don't know about you, but the guy selling hot dogs on the corner has a better profit margin than that. So I don't know how long they can sustain it. And like I said, they're selling the dream that, yeah, we're losing money now, but once we realize our full potential and penetrate all the markets we want to penetrate, then that's when we'll start making that money. Well, maybe it'll happen, maybe it won't. Usually it doesn't happen. Okay, but you don't hear too much about those cases when it doesn't happen. You hear about the 1 time in 100 that it does, and that's what fires everybody up to buy these things without reading any financial statements about it. Because if people did read the financial statements, they wouldn't be so excited about buying into companies like this. And so here on Zero Hedge, WeWork revenue from loss from operations, so $3 billion in revenue, and they're losing like $3 billion. Okay, not a good chart. And their WeWork valuation as far back as, I don't know, 2015, they were at a $10 billion valuation, and just at the beginning of this year, they were at like $47 billion valuation. Now where are they? Who knows? But it's not 47 billion. It's more like maybe 10 or something. So here's a chart of the percentage of IPOs that were losing money in the trailing 12 months before their IPO. Okay, and you see that that number, that percentage, has been increasing in the last few years to the point where it's now a higher percentage than during the internet bubble in 2000. And I don't know if people remember this, but during the internet bubble, anybody could IPO. If you tried to ask a company that was going IPO about making money or profits or anything like that, they would laugh at you and say that, profits don't matter. What matters is eyeballs, meaning how many people are actually looking at your website. That's the metric they want to focus on. They don't care about any kinds of profits or anything like that. And we all know how well that worked out. So, there's nothing new under the sun, and history doesn't repeat, but it rhymes. And so, it's human nature for people to want to believe in the story and not care enough to actually look at the boring details of the financial documents and if a company's actually making money. If they see it on TV enough and there's enough hype stories on it, that's good enough for them to buy the stock. So don't be one of those people that falls into the trap of buying the dream of these money-losing companies. So that's my video on WeWork. I hope you liked it. If you did, give me a thumbs up, leave me a comment. Let me know if you would actually buy this stock if it went IPO, and subscribe to my channel if you haven't done so. Thank you for watching.